Hello, everyone. We're just going to give it a couple of minutes to let people come in, just to make sure you can hear me. If you could just put a yes or a Y or anything in the chat, just to let me know that you can hear.
And where are you
Cool.
from? It's also important.
Oh yeah, yeah. But let us know where you're joining us
Last time,
today.
I think 2 times ago, we had someone from Hawaii, so I want to see another exotic name here.
People from all over Ireland,
Oh,
Estonia,
Cancun,
Mexico.
Mexico. This is not
Yeah.
fair. Come on.
Cool. So we've got a fair number in here. So um we're getting deep into it now today with number 7 in our presentation of the advanced aspects of trading course. I'm Peter Martin. Thanks for joining me. And this is really going to be the final part of looking at technical analysis, and we're looking at pattern analysis. This is traditionally quite it's a traditional part of technical analysis, and it dates well back before modern and technical tools for analyzing the markets. And really, this talk is going to be in 2 parts. You're getting 2 for 1. Half's going to be about bar charts, traditional patterns, and then the second part is going to be about Japanese candlesticks. They're really big subjects, and we could easily devote a whole talk to either one, but I don't think there would be that much of a gain in doing so. Think of this as more of a kind of taster. Before we begin, I will just direct your attention to the disclaimer as usual. Just make sure you have a good read through of that. It's very important just to understand that everything in the talk today, when we look at charts, if we look at a stock, and I'm putting a technical study on there, it's just for education. It's just to try and broaden your knowledge. It isn't in any way a kind of personal recommendation or any kind of instruction to buy or sell or any type of advice. So let's, now that you've had a chance to read through that, go into our agenda and talk about what we're going to be studying today. So we'll begin with an introduction, talking about why we want to look at patterns. What do we actually mean by a pattern? And then we're going to look at a handful of classic patterns. As I say, there's loads and loads of patterns out there. I think it actually can be confusing to try and learn too many at once. It just fills your head with too many things. It's better just to focus on just a few. So we'll look at a few patterns to find what they are, what you're trying to look out for, and we'll look at some actual charts to show you what they look like in real world examples. And then we're going to look at Japanese candlesticks. We'll have a quick refresher on the different parts of candlesticks, and then we'll look at a few candlestick patterns, classic ones that relatively short-term patterns. As I say, just a kind of taster. As we're running through, as usual, if you have any questions, make a note of the questions, and then we'll have a devoted section at the end, 10 minutes or so, to run through those in the Q&A section. Okay, so back before computing, before we could use kind of clever mathematical operators very quickly using computers, the main ways of doing technical analysis were by hand, drawing trend lines and recognizing patterns on actual charts that people had drawn. And computers have opened up all sorts of quick usage of mathematical relationships. Obviously, if you've joined us for previous talks, you know that we've talked about things like moving averages, exponential moving averages, Fibonacci sequences, and things like that. But classic patterns do have a long pedigree in technical analysis. I think it's pretty useful just to kind of have some kind of idea of how it works. And, you know, I would still say that the indicators we've looked at already are more important. They're more useful. But this is something that's kind of can be handy to have in your back pocket just so you know about it. Many patterns exist, both for short-term and long-term. The shorter-term ones tend to come up more frequently. They're not quite as useful as the longer-term ones. They are easier to recognize as well. Longer-term ones tend to have a bit more reliability, but they can be difficult to recognize as they're forming. And as this final point says, I've said it already, really, it can still useful to know some classic patterns. And here we have a quote from Al Weiss. He was a technical trader, made a lot of money through commodities, and was interviewed in Jackie Schwager's classic book, The New Market Wizards, where he interviews a number of legendary traders. And the quote is that the markets are ultimately based on human psychology. And by charting the markets, you're merely converting human psychology into graphic representations. I believe the human mind is more powerful than any computer in analyzing the implications of these price graphs. Now, when he said that, there is a caveat. Computers weren't quite as powerful as they are now. He wasn't talking at a time when there was AI. But I still think, as we'll see, these things aren't just kind of black and white. There's an element of interpretation going on. The human mind is very good at those sorts of things. So what is a pattern? So a pattern is a basic form or structure created by price movement. And it's sometimes also called a formation. So that's a pattern or a formation. We're basically talking about the same thing. With these classic patterns, they're bounded above and below by either trend lines or support or resistance lines. And the pattern begins when the price moves into breaking through one of these lines that's bounded above or before. If it comes from above, breaking down into it, then that is a entry from above. If it comes from breaking a price that's rising and comes through a resistance line, say, then that would be an entry from below. And then eventually the price will exit from these lines above and below. If it is a price coming from below initially, so if it was an entry from below and then it exits above, then that is what is actually called a continuation pattern. So the price is continuing on in the same direction. If it exits from below and then comes back out in the same, it exits down below. So it came in from, it was a rising price and it exits downwards, then that would be what's called a reversal. And that exit is often called a signal. Sorry, is often a signal, not called a signal. It can often be a signal, and that's where you take your action once you've seen the exit is where the pattern completes. So we can describe every pattern that exists using 4 variables that we've just been sort of defining. So we can have an entry from above or an entry from below, and then the exit either going downward or an exit upward. So using from those 4 variables, we can define any pattern. Now, those terms I talked about before, a reversal or continuation pattern, traditionally, that's how you would define a pattern. You would say, okay, this type of pattern is a reversal pattern, or this type of pattern is a continuation pattern. You don't really need to. In fact, we can just define a pattern by its shape, and a lot of patterns actually can be both. They can be continuation or reversals. So here's just an example. One, the pattern itself isn't particularly important, but it's just to let you or show you with an illustration what we mean by all those different terms we're talking about. So here we have a pattern with price entering from above, and then the pattern is the highlighted section. We can see that it's bounded above by resistance and support below, and then it's exiting upward. And so this would be a reversal pattern because it's gone out. Its price falling initially has ended up with the price rising. So the price has reversed. Some other features of patterns. Bar chart patterns are fractal. I think this is something we have mentioned before. They're not specific to any time frame. So you could look at a pattern for a weekly chart, and that same pattern will turn up in a 15-minute chart, a 1-minute chart, a 4-hour chart. So, for example, a double bottom is a type of pattern that we're going to look at in a minute. That might appear, as I say, you can see double bottom patterns cropping up in weekly charts, 15-minute charts, 1-minute charts, and so on. Of course, with a 1-minute chart, you might not have that much time to respond to it, of course. And then we got this idea of pullbacks and throwbacks. This is jargon. You don't really need to know the terms. They're not that important. You will see what they are in some of the diagrams. They're a form of retracement, a kind of so once the price is exited from the pattern, and that's our signal for to trade. And this is similar, or ties in completely with what we talked about when we talked about trading breakouts in one of our earlier talks. A throwback is whereas the price is moving upwards and then it is broken out of resistance, and then it throws back to that resistance level. And then a pullback is the other way around. If price is breaking downwards and then it pulls back towards the support level. So the way I always remember this, a throwback is just, if you think of throwing a cricket ball, gravity is going to pull it back down to the ground. So that's a throwback. And then a pullback is the opposite. And then failures is where after a breakout, the price fails to move a certain amount before reversing. And this could be anything that you decide. Typical numbers, for example, might be, say, it breaks out if it fails to move 10% before it moves back, retraces 20%, then that might be what you call a failure. And that would allow you to sort of go back and, when you're looking at these things, judge whether a pattern is actually valid or not, or useful or not, by using the whatever numbers you decided to define failure. Now, you do have to be careful. I've said this many times with all the technical analysis. You've got to have some skepticism and some wariness. As traders, we always want to be skeptical. And I think it's especially true with the patterns. It is human nature to see patterns, even if they're not really there. It's just the way our brains are wired. And there is no definitive proof that patterns are actually profitable for trading, because they don't test particularly well. The practices tended to be visual rather than mathematical. And something else worth bearing in mind is that the emphasis on patterns in modern technical analysis is less than in the past. So as I said right at the beginning of this talk, you probably want to lean a bit more on modern indicators rather than this. It's just something that's useful to know about. And this final point is a difficulty in using patterns, is that they're much easier to see in hindsight. Sometimes they're not even that easy to see in hindsight. But the trick is that you've got to see them when they're still forming. So you've got to be able to see, okay, this might be happening, and I'm waiting for that completion signal of the pattern. That is the signal to trade. So let's get on to look at the first of our classic patterns. One of the most well-known are these double formations, double top, double bottom. So these actually are a reversal pattern. A double top is prices rising it's where it peaks out, and you expect it to reverse if you see this happening. And a double bottom is where price is falling, and you expect price to bottom out if you see this pattern. They aren't particularly reliable. And when we talk about the reliability, that's based on the observations, really, of a pattern authority called Thomas N. Bukowski in his book, Trading Classic Chart Patterns from the early 2000s. In my anecdotal experience, I think these aren't that bad, but let's talk about what they actually are. So a double top is, as is shown in this diagram here, it's two peaks either side of a trough, and the price enters from below the trough. And then the two peaks, this is a key part of the double top, is that the two peaks must be either at the same level or very close to the same level. So double tops get talked to a lot about in media, and you might hear about them in financial news. But often when people are talking about them, they're not really true double tops, because those peaks aren't quite at the same level or similar levels. And then the sell signal is when it breaks, as we can see on the right of this diagram, below the support level. So bounded above and below by resistance and support. Price enters from below. We get the two peaks with a trough in the middle, and then it exits when it comes below that support level. And then a double bottom is the opposite. It's the reverse. So the diagram is really upside down of what we've just looked at. We've got two troughs either side of a peak. Price enters from above that peak, and then the troughs must be at or close to the same level, that key thing again. And the buy signal is when price breaks above the resistance level of defined by that peak. So if we look at an example diagram here, so this is just a line chart of daily gold, and we are looking at kind of March and April 2022 in that highlighted area. And we've got a double bottom formation. We can see the price was in late 2021 through to February 2022, prices falling very steeply. And then we get the in the highlighted area, we can see the same level, those two troughs with a peak in the middle. And then the breakouts occurs when we would say our resistance is defined by that peak in the middle. And then when price breaks above that, that would be our signal. As we can see, that did actually herald a big reversal in the price of gold. Let's actually go to eToro's platform now. Let me just find where that is. Here it is. And what am I going to look at? I'm going to show you, let's have a look at it. Look at NVIDIA on a 15-minute chart. Yeah, so here we've got it's not that easy to see, but you can see here that the price is we don't get the perfect. Where am I looking? So this is a sort of example of it. There's one that doesn't work out very well. That's right. So if we got here, we can see we've got the pattern a bit hard. Maybe zoom in a bit more. This highlighter is a bit fat for the purposes of drawing here, but we can see that the price rises up. We get a peak, a trough in the middle, and another peak. But then the formation
Peter,
doesn't.
just a second.
Sure.
Someone wrote he can't hear you. Can you guys let us know if it's only Francisco problem or it's Peter's problem? Because I can hear. Okay, yeah, you continue. Peter, you can continue. I'm sorry.
Cool. No
Thank
worries.
you, guys.
Let's realize that's not a great example. So that was an example where the formation sort of occurs, but we don't actually see it play out. So you can see these patterns don't always give you exactly what you want to see. I'm just trying to find where I had a better example of one. Yeah, so here is another one where we actually see it work properly. So the price is rising. And then we're talking about this area here. So we've got there's our double top, and the price comes out, and we have a breakout signal, and the price does reverse. And then double bottom we already saw in gold, but I'll show you it again in the chart package here. Let's go. That was a daily chart for gold, and it was back in last year. It's strange. It doesn't seem to tally up with what we were just looking at. Oh, yeah. So, well, we definitely got one here anyway. This is almost more of a what's called a treble bottom there. I can't quite see it. I thought it was maybe if I zoom out. We'll go back to the presentation. I can't quite see. Oh, it was March and April, not February. Okay, but let's move on and go to the rectangle. So the rectangle is a pattern that we've actually introduced in previous talks without really defining it as being a rectangle pattern. This is the idea of the sideways market. So the idea that price being bounded above and below by support and resistance that are horizontal. And what's important here is that the price must touch support and resistance at least twice. So if you think in our double top and double bottom, we only got the one peak or the one trough, so it only touched one of those lines once before breaking out. Support and resistance lines must be parallel. And then what we're looking for is an eventual breakout, and it can be from either side. So this is neither a continuation or a reversal pattern. It can be either. So let's go back to our charts. And actually, I'll have it on the next slide. I do have a, right, yeah, so here's a diagram of that. So this introduces the idea of the shortfall. It's this kind of partial decline or partial rise. So we can see on the right of the diagram, the shortfall where price has been stuck in this range. It's touched support and resistance at least twice to complete our pattern. On the way down, we've got a shortfall so that buyers are coming in early. It's sort of showing they're getting a bit trigger happy. The buyers are got more enthusiasm. And then we get a breakout on through the resistance. Some analysts do consider it to be a continuation pattern, but from the evidence I've seen, it can be either. So let's so here's an example with Antofagasta, which is one we've talked about before, where it's a daily chart of Antofagasta. We can see it bounded between resistance and support zones. It touches those a number of times before finally breaking above. I'll go back to the chart package and we can look at some more examples. So let's have a look at Microsoft. So we can see with Microsoft here that if I grab some horizontal lines, we can see how there are some support and resistance. We do with this one get this interesting kind of fake breakout here. We can see on about the 25th of October, clear break above, and then it actually fakes you out and comes back in, but then it does break out of the rectangle pattern and we get a clear breakout to the upside. So once again, it kind of shows you the kind of wariness and care that needs to be applied when you're looking at these things, how the market can fake you out. This signal on the 25th of October, it ultimately, if you'd acted on that, wouldn't have worked out in your favor, but at the same time, it wasn't a sort of pre-indication of what ultimately the market ended up doing. It was already showing signs of the buying power that was sort of bubbling over there in that market. And then if I go to oil, we might have another example here. go to, this is going to be a daily chart of oil, sorry, a 4-hour chart of oil. So we can see the kind of support down here, and we've got there's you can argue about where this resistance actually is, but I think it's around about here that we can see how the price has sort of been bounded in this sideways region, and then ultimately breaks out of the rectangle pattern. It's just going to draw another horizontal line because you can argue where the resistance actually is a bit, but we can see it's maybe a zone a bit more like that. But we can see also how once price is broken out, it sort of retraces a little bit to that resistance, which becomes support, that zone, previous resistance becoming support, and then we do get the breakout to the upside, and quite a large uptrend that followed subsequently. And then another well-known pattern is the head and shoulders pattern. It's a well-known pattern. It's got multiple parts to it. Sometimes get a bit of a bad reputation. This one is almost contributing to the kind of reading the tea leaves criticism that pattern recognition sometimes get, but it actually has a fairly decent kind of track record for predicting these breakouts. So it's often seen at the top and bottom. So if we see it at the top, it's head and shoulders. If it's at the bottom, then it can be called an inverted head and shoulders, or a head and shoulders bottom is another name for that. So the top obviously follows an ascent. It marks often the top of that rise in prices, and then if it's a head and shoulders bottom, then it follows a decline in prices. So we've got these three distinct peaks. If it's at the top, if it's at a bottom, then you're going to have three distinct troughs. And the middle of those is always the largest. So you have the left shoulder, the right shoulder, the head in the middle, which is the largest of the three. The left and right shoulder don't need to be the same size. They just need to be smaller than the head, and they need to be distinct peaks or troughs. And this line of support or resistance, in this instance, is a line of support when it's a top. It's called the neckline, and the entry is where it breaks through that neckline, and then you only start to realize the neckline is there when you see the support level from the price pulling back to it each time, and then the exit is when it breaks out of the neckline. On this chart, I've also marked out a pullback, which is what you often see, as we've discussed before. So trying to see if I've got an example of one of these. Well, we'll have one on the next slide. Okay, so this is a head and shoulders bottom or inverted one, which is just the other way around. The pattern has a kind of rough symmetry to it. As I said, the neckline is the clear trend line, either the support or resistance. It doesn't have to be absolutely horizontal. It could have a slight incline to it. And then the breakout signal is when it exits beyond the neckline after the formation of that second shoulder. With these patterns with the head and shoulders, either at the peaks or at the bottom, pullbacks or throwbacks are common. So throwback being the one where the price is rising and then it drops and then it rises again. So this is a chart of Yum Brands, American company. It makes various food products. And this is a daily chart, and it's back in, I think that must be, so that's late 2022. So we can see this inverted head and shoulders pattern there. I've marked the neckline on. You can see how you get a first peak, then a head, and first trough, and then a deeper trough as the head, and then another clear third one, which is the second shoulder. And then when it breaks through the neckline, that's your signal. And we can see this one, we didn't have much of a throwback on this one. Let's have a look at the go back to the platform, just try and see if we can look at some examples. So this is a 4-hour chart of American Express, and just kind of looking where we are now, we can see we've got a kind of, it's not the greatest one, but it's a rough one of, we have price coming down here, and we can see this would be our first shoulder, and then this would be the head, and then this would be the second shoulder. The neckline would be all the way up here, and then our breakout would be here. So we look like we've got some kind of a breakout through that neckline there, which is quite interesting that it's not. I'm having to sort of go back and cherry pick. It's right there on American Express right now. Just not the clearest or best example, because it doesn't, its symmetry is pretty ropey, but it is still a head and shoulders bottom pattern. Okay, so that is actually I will just quickly show you one further thing. Having talked about the rectangle pattern, I should also mention, it's not in the slides, but I will my rectangle. Let's go back to Microsoft, and this is when we were talking about having the rectangle pattern. There is also patterns that are called triangles, and they're sort of a variation on a rectangle, but it's where the lines aren't strictly horizontal. So you might have, rather than if you've got your support line is horizontal, and then you actually have a trend line coming down like this, then we would call this a descending triangle. Or if you had your resistance was horizontal above, and you price below the support was moving upwards like that, you would call it an ascending triangle. But it works in a very similar way to a rectangle, in that ultimately you're looking for a breakout signal above from your lines above or below. And I can show you an example of one I was looking at, I think on Vivendi. Yeah, so here we can see that we've kind of got some pretty clear horizontal support in this 4-hour chart of Vivendi. But if we look at what starts to happen, initially we get horizontal resistance up here in July through to August. But after August, we can see that we could have started to draw a trend line like this. So what you've actually got is a descending triangle, and then price broke above that resistance line, and that would be your breakout signal. And not the best breakout ever, although price is elevated from where it broke out. Okay, so now let's move on to the Japanese candlestick. So let's have a quick refresher about what the different parts of the Japanese candlestick are. So candlestick patterns, all those charts I was showing you were with Japanese candlesticks on it, because I find that easy to look at, but you could when you're looking at patterns, you could do it with bar charts. You could look at just line charts really as well. But a candlestick chart displays open, high, low, and close data for each period on your chart. The high and the low are shown by the wick of the candle, which is also called sometimes the shadow of the candlestick. So the upper shadow would be the upper wick shows you the high of the day. And then the lower wick or lower shadow would show you the low of the day, these thin lines that represent the extreme range of the period. And then the open and the close are shown by the body of the candle's body, which is also sometimes called the real body. When a candle is green, it shows that the close of the day or the close of the period was higher than the open of the period. So when it's a green candle, the close is at the top. When it's a red candle, it shows that the close of the period was lower than the open. So it's a negative price movement across the period. And we would put the close at the bottom and the open at the top. So when you're working with candlestick patterns, all the things that we've discussed already when we're talking about trend analysis work with these. And in fact, when I've been looking at my charts, I'm often been using candlesticks, so they work perfectly for using trend lines, support, resistance, and patterns. But they also have their own set of idiosyncratic patterns. These sometimes have these colorful names attached to them. And the patterns tend to be pretty short. Sometimes they can just be one candle, or they may use 2, 3, sometimes 5. The ones I'm looking at here today are mainly 2 and 3. More often than not, they're reversal patterns. There are a few continuation patterns, but most of them are reversal patterns. And they're often based on the relationship of open and close to high and low, and of one candle to its neighbor. Probably the most important thing to stress is this final point. As always, think about what's happening with the trend. Think about how the pattern fits in with what you're seeing with the trend. And bear in mind that the pattern of the candle is just another piece of information to inform your thinking. And the main thinking is about what we're seeing with the longer prime pattern. So this is a one candle formation. Doesn't mean that much really by itself, but it's worth talking about because it crops up quite a lot. It's the idea of the doji. And the doji is where the open and close are so close together that the candle body doesn't show any size. It's just a horizontal line. And this implies that there's some kind of indecision going on, or maybe some equilibrium in the market between buyers and sellers. You don't get any clear winner between buyers and sellers. So it can be a warning of a reversal. This really has to go hand in hand with context. For example, one thing that you might see is that if you see after a steep rise and you saw a doji, then that might be thought of as the market getting tired, and this might be about to reverse. And then here's another one, Harami. Once again, this sometimes plays a part in longer patterns. So this is a 2-period pattern. The candle colors can be either, it doesn't matter. But what is important is that the second candle has to be small and entirely contained within the range of that first body of the candle. The wicks don't have to be like that. It's all to do with the bodies. And it shows a drop in volatility in the market, and it may point to a change in trend or an acceleration of the previous trend. So it doesn't tell you too much. Let's see if I've got it. Okay, so let's go back to the platform. I'll just show you a few of these in action. So I'm going to go to a commodity. I'm going to go to cocoa. I'll just zoom in here. So, for example, here in mid-October, a couple of dojis in a row, another doji up here. And just trying to look if I can spot a harami anywhere. There's one here, so we can see big green candlestick body with a small little red body entirely contained within the body of that first candle. And we can see that there is a short reversal in price after we saw that. So the was previously ascending and then a slight pullback. So another pattern is this one that's called hammer or hanging man. What defines whether it's the hammer or the hanging man is where it appears. So the candle looks the same for either one. So the candle for both the hammer and the hanging man is this little candle body that's at the very top of the trading range. So it doesn't matter if it's green or it's red, it can be either. But we need this nice long lower wick on the candle that's at least twice as long as the body, and then the upper wick is very small, or it's not even there at all, i.e. a kind of doji. If it occurs after an advance, after price is rising, then that's when it's called a hanging man, or it's there at the top hanging down like a hanging man. If it occurs after a climb where the price is falling, then it's called a hammer. They're both reversal patterns. So let's go back to the platform and I'll stick with Coco. I'm going to go to weekly. I'm going to go all the way back here and we trying to spot I had a quick look at these, obviously as preparation to look up a few of these, and I made a note that there was one yeah, here it is. So we got the decline in price in June 2020, and then we have a hammer down here where we've got the small body at the top, and then this long lower wick that's much bigger than that body, and that's a reversal pattern, and we can see the price did reverse back. And this is looking at weekly charts, so it's a slow moving thing. And then also let's go to Verizon on a daily chart and go back to earlier this year. Yeah, so we can see here prices rising in late January, and then right at the end of the month, beginning of February, we get hanging man. You actually get a kind of couple of hanging men formations there. So we can see the small candlestick body, the much longer lower wick, and then there's your reversal. Obviously, these aren't always going to work out. I'm giving you examples where they do work out, but that doesn't have to be the case. Oh yeah, so there's the Verizon example again of the hanging man. And then this is just a closer crop to show you that what I've just shown you in the platform. And actually we can see another one there in the middle of February as well. So a couple of hanging man formations. Now this next pattern is called engulfing. It's a 2-candle pattern, and the candle colors have to be different. And the second body engulfs the first one. So it's the whole of the body has to be fully bigger than the first one and envelope or engulf the whole of it. And it suggests that the dominance of the second color or suggests dominance of the second color. So if we've got the diagram here, we've got a small green body with a large engulfing red body, then that means that the selling pressure, bearish powers are bossing the buying power. So that is a bearish engulfing pattern. If it's the other way around, if we had a small red candle and a big green candle engulfing entirely the body of the first one, that suggests that buying pressure is in ascendance. It's pushing around the selling power, and that's a bullish signal. So that would be a bullish engulfing pattern. So sticking with Verizon, another daily chart. This is in kind of about a year ago, October 2022. We can see the price was declining. And then in the middle of the month, highlighted, we can see the pattern where we've got the small red candle body fully engulfed by the larger green candle. And that's a bullish engulfing. And we see that it heralds a slight reversal in price after the dip. And we'll go back to the platform and look at another example. If I go to Macy's, getting ready for the Macy's Day Parade, and we'll look at daily chart of Macy's in so this is very recently. We can see in October the price of Macy's was rising. We get this green candle on the 3rd of November, and then on the 6th, which is for the weekend following, after the weekend, the whole of that green candle is engulfed by the red candle that follows it. So it's a bearish engulfing, and the price reverses. And then the stars pattern is another reversal pattern. It's a 3-candle pattern that marks a top or a bottom. So a star is a candlestick with a small body that sits completely outside the range of the previous candlestick's body. So it's effectively got a gap, and it's a small little, what's actually, as well as dojis, we have these things that whereas a doji is the one where the open and close are so close together you just get a horizontal line. If you get a very small body that's got a bit of color in it, that's often called a spinning top. And so a star is kind of a spinning top that is sitting outside the range of the previous candlestick's body. Now, whether it's a morning star or an evening star is to do whether it makes a trough or a peak. So if you see this small body sitting separate from the previous candlestick, and it's the prices have been rising, then that's an evening star, which indicates that the price is going to go down. And then a morning star would be where the price is falling, and we see this little body separate from the previous candle, and that would make a trough. So it's supposed to indicate a stalemate between bulls and bears, and then it's flagging a shift in who has got an upper hand in the market. So this diagram on the right here shows you the morning star pattern I was talking about. So we've got this long red candlestick on the left, and then the second one is a small body that's entirely beyond the first body. And then the final candle in the pattern has to be a green one digging deep into the body of that first red candle. So that's what's indicating this kind of trough formation that we would expect to see. And then an evening star is the other way around. So we've got a green candle as the first one. The second candle is the small body, sits entirely beyond the body of the first one. So the wicks can cross. That's not important. It's where the bodies are in relation to each other. And then the final pattern of the 3-candle pattern is this long red one that digs deep into the body of the first green candle. So I've got an example here of chevron of an evening star, and this is a daily chart of chevron in June of let's have a look when that is, if that's June. Yes, so this is daily one. This is June 2022. And the highlighted area there is we show in June. We can see that the price was advancing all the way through May and into early June. And then we get this long green candle, the small green candle that sits separate to that body of the first green candle. And then the 3-candle pattern is completed by the long red candle eating deep into the green candle, the first one. And that is your evening star pattern. And it did indeed mark a peak. And then we saw that it just so happens that we've got this big downtrend afterwards. But just bear in mind, the pattern is supposed to be a short-term signal. It doesn't necessarily mean that that's going to happen. We'll go back to the platform. And we can go back and have a look at, stick with Macy's here. If we go back to June. Yeah. So we zoom in here. We can see it here that we get a big green candle, small one that's a little bit higher than it, separate, and then the red digging deep into that first green candle is a kind of evening star formation. And then our final pattern we're going to talk about is the 3 inside up pattern. 3 inside up, it's a reversal pattern following a decline. The first candle is this long red body. Second candle is a small green body. And the third is a long green body that extends above the first green in the pattern. So what you'll notice with the first two is that it's what we've already defined as a harami, right? So it's the big green candle with a small body entirely contained within it. That's the inside and then up. So 3 inside up. And then, sorry, I said that our final pattern. Here's the reverse of the 3 inside up as the 3 inside down. So it's a reversal pattern following an advance. We get a big green, a long green candle to start with, small red inside the body, so it's an harami, and then the third one to complete the pattern, it's a long red candle that extends below the first candle in the pattern. An example here is with travelers, the daily chart of travelers, and we can see the highlighted are 2 examples of 3 inside up. So we've got a long red candle and then a small green one contained within its body, and then a third one that is above. And we can see that both in August and in October. Long red candle, small green candle contained within its body, and then a third one that pushes higher. Do I have an example? I might have an example in the actual platform. Let's go and look at oh yeah, so let's just I think we'll look at travelers, which is a big insurance company in the States. And yeah, so that actually we'll just be looking at what we showed you on in the slide. So we have a big red candle here and then a small green one. It's an harami, and then a third green one pushing above that middle one. So we can see that is a reversal of downwards here and then moves into an upwards movement following the 3 candle pattern. So as I said, this is really just a kind of taster. I didn't want to, I mean, we've actually gone through quite a few patterns of the candlesticks there. If you want to read more about it, there are books on these. Here are a couple of books that I think are pretty good. I mentioned the first one already, Trading Classic Chart Patterns by Thomas Bulkowski. And in that, he not only goes through all these classic chart patterns, as I said, he sort of tests them out and tries to give scores for reliability to different patterns, which is pretty, it's not too many people have sort of published information on that. And then Steve Nissan is actually the guy who sort of brought to the West the idea of Japanese candlesticks in the 90s. He came over, he went over and spent some time over there and came back with these kind of interesting names for these different candlestick patterns. Before that, people really weren't using it, and since then it's taken over. But that, he's written a couple of versions of that same book, the Japanese Candlestick Charting Techniques book. So in summary, it's kind of a whirlwind tour of some patterns, some candlestick patterns, some classic chart patterns. None of it removes the need to be aware of what's going on with the underlying trend, the thing that we can't stress too much. Always have your eye on what's going on with the trend. Some of these chart patterns are sort of short-term reversal signals that fit in within the context of that larger trend. They only hint at possibilities. Just because you see the pattern, it doesn't mean it's going to happen. The more familiar you are with the patterns, the more you use them, then the easier they are going to be to recognize. It's always a good idea to sort of try and gauge for yourself how much you rate the effectiveness of them, and consider combining them with indicators and other analysis. So they're just a piece of information that adds to the picture you're seeing of what's going on with the market. Obviously, the things we've looked at already, things like moving averages and support and resistance lines, trend and other different parts of trend analysis, they are more important really than pattern recognition. Okay, so here is the chance to put some questions to me. I'm just going to do a quick time check to see that we're okay. We are very good for time. So let's have a look through at our Q&A. Someone asked, do these patterns work on long-term or short-term when trading oil? As I said, the idea is that the patterns are fractal, in other words, you see the same patterns forming within different time frames. So charting technical analysis as a whole is always supposed to work this way, that it's not restricted to one time frame or another. With the candlesticks, I would say that they originally were supposed to work with daily charts, but there's no reason that the same thing doesn't necessarily apply. What they're telling you is giving you a visual picture of what's going on between buyers and sellers, and we just sort of need to apply our understanding of that from what we see to work out what it means. So when we see patterns that indicate a kind of a stalemate between buyers and sellers, we know that we can then combine that with information we look at from indicators of volatility to maybe see if it agrees or confirms what we're seeing there. And then we know often if we see those kind of situations, they can sometimes be a precursor to breakouts and a pickup in volatility, which is all a long way of saying, yes, these patterns don't need to be restricted to just long-term or short-term. You can use them on any time frame of chart that you're looking at. Someone else, is price action a key pattern? Well, price action itself is, all of this is really price action. Technical analysis is looking at what price is doing. Trend analysis leans heavily into price action, or we could say what the trend is doing is the single most important thing that we can discern from looking at the price action. So patterns are all a type of price action, but really, the most important thing that we see in price action is the thing we talked about in our first trend analysis talk, which is to say trends occur. We need to try and recognize what the trend is. There are three types of trend: up trends, sideways trends, down trends. And as technical traders, really, the ideal is to identify the trend when it's moving up or down, trade in that direction, and ride the trend to try and maximize our profits as best we can. And in those times when we are wrong in the trend, there isn't a long trend, to get out before we take too much of a loss. Someone asked, can you introduce some highly reliable patterns? I've tried to talk about the ones that are sort of the best, well-known, or a combination of well-known and reliable. According to Bukowski's book, some of the most reliable patterns are head and shoulders, and the triangles, the descending triangles and ascending triangles. So I mean that's why I sort of mentioned some of those. Someone asking, could algorithmic trading be the reason why we see an increment of these patterns showing? A machine detects one of these patterns and sells or buys accordingly, thus making it happen more often. It's possible. I mean, I think there's a big debate to be had anyway about there's different economic theories about whether these patterns can be used at all, because one major line of thinking is that it's the random walk thesis that says you cannot reliably make money by recognizing patterns. It's all random. The efficient market hypothesis, effectively. Technical analysis, if you believe in technical analysis, says that isn't always the case. There are times when the market behaves inefficiently and you are able to recognize people behaving in a certain way that they've behaved before. I don't think that latter line of thinking is that unreasonable, because I've definitely seen instances of people behaving irrationally. We know people don't always behave rationally, and when people in large groups often can behave irrationally. If you think back to the various bubbles throughout history, the tulip bubble, these are instances of irrational markets. And therefore, one of the arguments for the strength of technical analysis is the idea of, part of it is it's a self-fulfilling prophecy, that if you get enough people trading a market, in absence of any kind of major driver, who believe that there is, are looking at previous resistance at a level and believe it has an influence, then they're likely to behave in a way that reinforces that resistance. And the same goes for support. Eventually, they can't control the market and other forces will take control, which is why we get these breakouts. And when it eventually breaks beyond resistance and support, then often the market can trend, and those resistance and support levels are actually just left like gossamer in the wind. They're not of any great importance anymore. They're a temporary force in the market. And the same thing could apply for algorithmic trading, that if algorithms are designed to recognize the same things that people are responding to in terms of resistance and support, then that could reinforce and create certain patterns until more fundamental forces take over and break out of those areas. So someone says about the candlesticks, I'd expect the open price of one candlestick to be the same as the close price of the previous one, yet there can sometimes be gaps, no overlap at all between candlesticks. What can cause this? Well, markets don't have to open where they previously closed. It depends upon what the rules are for the market. uh, different markets can trade in different ways. If you're talking about a futures market, gaps are very, very easy. And also those markets can be shut for reasonably long periods of time. An example of, for example, so when you're trading as CFD on a commodity like cocoa, the price is actually derived from the futures market that trades on an exchange. Now, that exchange only has a certain number of hours in a day. It's not open 24 hours a day. So there's a fixed and defined open and close, and it might be a relatively short trading day. It might be, I don't know the exact trading day hours of cocoa, but it might be something like, if I remember correctly, the kind of times you're talking about are maybe 9:30 or 10 in the morning till 4 in the afternoon or 3:30 in the afternoon, relatively short trading day. And also on top of that, there are certain rules that are applied by the exchange that ultimately defines these prices trading on the futures exchange, how the market is allowed to behave. If it moves beyond a certain amount, some of these exchanges have rules that say it goes limit up or limit down. They just stop trading to stop it moving too much in a day. When it comes out of being limit up or limit down, the price can gap. And gapping is just where someone agrees to buy. A trade occurs when someone says, well, would you like to buy this at this price? And the other person says, yes. A trade goes through. There's nothing that says that has to be at the same price as where the market was previously closed. So it can just gap. Even on the London Stock Exchange, you have the London Stock Exchange operates under a system called SETS, electronic trading system, that has rules of how things work. It has an order book where people put in bids and offers. When the bid matches the offer, it will match those trades up, and a trade goes through at the price that they agree on. At the end of the day, it goes into it has a process by which they get a closing price, and it goes into a kind of auction, and a similar thing what happens on the opening in the market. So they will arrive at what a closing price and an opening price is, and they don't have to be the same thing. However, I believe something like the Dow Jones Industrial Average, the rules are that it always opens at the same level as it previously shut at. So it depends on the market. Someone says, what can you see about Netflix at the moment, Nelly and Resistance? For a moment, I thought someone was asking me for a recommendation of anything good on Netflix. Let's have a look at Netflix. We'll give it a go. No promises. So Netflix, one of the FANG stocks. And so we're looking at it on a daily chart, and I think that's a nice way to look at it. And the question is, what can you see at the moment? Nelly and Resistance, not quite sure what the bit in red. Let's get rid of that. Well, first of all, I'm going to look at the weekly chart just to sort of get a feeling for the longer term picture. So we can see that is in this long term uptrend from this weekly view. This is just an inaccurate support line. And we can see that the resistance is also traveling on a sort of channel in that time frame. Maybe it's decelerating a little bit, but if we go to the daily chart, then we do start to see some evidence of resistance kicking in there, don't we? So it's starting to get a bit of a sideways cast there. mean, these are not accurate, these lines. I'm just drawing them very roughly. I'm not touching pretty much any of the candles there, but just to give you an idea of a kind of resistance zone that appears to be setting in. But I mean, if it is, actually, let's move this one. If we say this is kind of resistance, and we can see that we got levels up here, it's not that clear. Once again, other tools at our disposal are, we could put on some moving averages. I'm going to put on MA cross. And I quite like 10 and 30. Now we can see let's just get my long thicker so I know exactly what it is. So the moving average cross is giving us this bullish signal. And they're both pointing upwards. The long-term trend on the weekly is bullish. But we can see price has sort of bounced. I mean, it had a good push up here up to like 480. But it's met resistance around about this 450-ish kind of level. But currently at 460. We zoom out. I mean, I don't know whether these are all-time high prices, which it may explain why. Oh, no, they're not. Well, we can also see though, so in the long-term view, we can see that there was on that. We can see that we had quite a lot of support for a long time around about this level, didn't we? Up at around about 470, 480. Market participants probably going to be looking back at that and saying, could there be, I mean, so I mean, the indicators are currently, there's nothing to suggest there's an end yet to this previous uptrend performance. Although we've seen it bump against some resistance around about 450, we can see that currently it's sort of poking through it. And I would just have my eye on this previous support up here at around about 475, 480, which might be part of this band of resistance. And that's really all I have to say on it. I mean, I would look at what it, continue to monitor what it's actually continuing to do. The moving average, my trend lines suggest upwards trend movements, which is what we've been seeing. Bear in mind, those are lagging indicators and don't predict the future. Final question, because actually, two more questions. Someone says, should you immediately put a trade upon completing the pattern, or should you wait for a pullback? There are no black and white answers to this. It's at your discretion. I don't know if you joined us from the previous talks. We did talk about trading breakouts and pullbacks. It's a trade-off. If you trade early, you're more likely to get caught out by the false signal. At the same time, you get more of the profit if you're right. If you wait for the pullback, you probably get a bit more reliability to get it, At the same time, there might not be a pullback and you miss out entirely, and you also run the risk of missing out on some of the price. It's a trade-off of those things, and you would have to, I personally would lean towards looking for trading infrequently and waiting for a stronger signal and getting in when I see the stronger signal and not waiting for the pullback. But trading the markets is entirely a personal thing. Lots of different people make money trading different ways. It's finding the way that works until it doesn't work, and then you give it up. Someone says, would you please peek at the NASDAQ? Thank you. I will, definitely. So fortunately, the indicators stay on, which makes it useful for me. So just using this moving average cross, and you'd probably want to get a longer one on as well. In fact, I'm going to add a longer one on. I'm going to put on the 100-day moving average just to give me some more information. Oh, I don't want the adaptive. I want moving average. Let's get rid of the adaptive. And I'm going to put this at 100. So the long-term moving average is got a slight downward gradient, but it's largely flattish. Our shorter-term moving averages are both pointing up, but they're quite close together, i.e. they could be about to cross. But what's interesting is that the shortest moving average is above. So the 10-day moving average is above the 30-day moving average, which is above the 100-day moving average. So those are kind of, we normally would take those as bullish signals. Price is currently broken above even the shortest moving average. So we're seeing this kind of short-term push higher, which is kind of bullish. And if we were to look at, sorry, this is a weekly chart I'm looking at, so we are looking very long-term. If we look daily, daily's kind of interesting in that we've had this bullish cross of the shorter-term moving average, the 10-day above the 30, but they were both depressed below the long-term moving average, but the short-term one has just pushed above it. And if you look at what, just eyeballing the NASDAQ from the daily chart, it has this sideways look to it since the late summer, and then bullish before that. And obviously you can sort of see that reflected in the shape of the in the blue long-term moving average. So there's some indications just from, a very cursory short-term study of the NASDAQ there that it's, and always with the caveat, bear in mind, these are lagging indicators, that we've been seeing bullish behavior on a daily basis pre-summer or early summer, then flat, and some indications of some bullish forces giving the market some pep just in the last few sessions. Okay, well, that is us running out of time. We've been doing this for an hour and 20 minutes. Thank you very much for joining me once again. Please come again next time. And next week, we are going to, I believe we're looking at pairs trading. So it's almost like Monty Python, and now for something completely different. We've spent a few weeks looking at technical trading. It's a different idea we're going to be doing altogether, really, from what we've been looking at before. Hopefully you'll find it really interesting. Please, as many as you can, join me again next week, and I'll see you then. Thank you. Bye-bye.